So one of the main shareholders equity accounts is that of common shares and preferred shares. So common shares and preferred shares. So essentially, let's just say hypothetically that me and you were business partners and we manufacture water bottles and we sell it for a profit. So in this business, let's just say when we first started off, we first invested our money into this business. So we bought a delivery van, we rented out a space, and we're running our business. Now, as time goes on, we're very successful. Okay, we're like, you know what? Now let's go out and buy a building. So we need $2 million for a building. The thing is, we're not going to have that type of cash laying around. So we have two options now. So there's two options in this case, which we have first, we have debt financing. So in this situation, we go to the bank, we take out a loan. And the second option is we have equity financing. So there's two ways a business could finance its operation: debt financing and equity financing. So there's three actually common forms of equity financing. There's common shares, preferred shares, and then there's retained earnings. Retained earnings I'm going to deal with in a different video, but common shares and preferred shares. So all this means is that we're going to go out to the public and we're going to issue shares to the public. So what that means is we're giving up ownership stake in our business for cash. So in debt financing, we take out a loan. We take out a loan and we pay it back within 5 years. Let's just say, for example, so we pay it back within the period that us and the bank, we agree upon, right? So within debt financing, we don't give up ownership in the business. However, we're obligated to pay yearly or periodic interest payments now, correct? So whereas with equity financing, we give up ownership in the business. So with equity financing, we give up ownership in the business. However, we do not have to pay the money back. And there's no obligations to periodic payments, correct? So once again, to kind of recap, the biggest pro of debt financing is we're not giving up ownership in the business, but the biggest con is that we have to give periodic interest payments. Whereas with equity financing, the biggest pro is that there's no periodic payments required by the business. However, the biggest con is we're giving up ownership in the business. So now let's talk about the difference between common and preferred shares. So before we do talk about that, I want to kind of go back to equity financing. So even though we are not required, the keyword is required to provide periodic payments, right? A company could still declare a dividends, right? However, a dividends is not an obligation unless a company declares it. Very key, right? Company can still declare dividends. So let's just say, so essentially the definition of a dividends is a payment that a company makes to its common and preferred shareholders, pretty much say thank you for investing in our company. But so I'm gonna talk about dividends in more detail in the retained earnings video, because that's directly related to retained earnings. But so I am going to talk about dividends in more detail in the retained earnings video, but I'm just introducing the term right now. So once again, a dividends is a payment made to common and preferred shareholders saying thank you for investing in our company. Now let's talk about common shares and preferred shares. So essentially the main difference between common shares and preferred shares is that common shares have voting rights. So this means that they can vote in key decisions of a business. So essentially, if you own 51% of the voting rights of a business, you essentially run that business because you have the majority vote. So if you buy the common shares of a business, you're giving up cash and you're in return have voting rights in that business, and you have ownership in that business as well now. So preferred shareholders also have ownership in the business. However, they have no voting rights, but they have first preference on any dividend payments the company makes. So let's just say hypothetically that the company made a dividend payment out to its shareholders, right? So the shareholders are its common shareholders and the preferred shareholders. However, the company only has enough to pay the preferred shareholders and not the common shareholders. So since the preferred shareholders have no voting rights, they're entitled to the dividends before the common shareholders. So let's just say hypothetically that the company pays out a dividend of, let's just say, $10,000, and the preferred shareholders are entitled to, let's just say, $12,000, and common shareholders are entitled to, let's just say, $8,000. So since the company pays out dividends of $10,000, the entire $10,000 is going to go towards preferred shareholders. That means $0 is going to go towards common shareholders. And since the company does not have the full amount to fulfill the preferred shareholders entitlement, that doesn't matter, because remember, under equity financing, a dividend is not an obligation unless it declares it. So since it only declared $10,000 in that year, that's all they have to pay out. But let's just say hypothetically that they declare $0 of dividends. That means that 1 year, the company does not have to pay out a dividends at all to preferred shareholders and common shareholders.